All right, let's get right into it. The Indian market is really on a knife's edge. After a seriously nail-biting month, we are staring down a massive week ahead, one that's packed with triggers that could either send stocks soaring or send them tumbling. So what's actually going on here? Let's break it all down.
So let's just start with this big, kind of sobering number, negative 12%. Yeah, that's how far the Nifty 50 has dropped from its all-time high. It's a really clear signal that, the big party might be over for now, and we've definitely waded into much rougher waters.
And that really brings us to the main theme of the moment. The bears are in control. I know, the market only slipped a tiny fraction last week, but seriously, don't let that little number fool you. The underlying trend, the real momentum, it is firmly negative. Right now, the sellers have the upper hand, period.
But even when the overall tide is going out, there are always these little islands of strength. So let's peel back the layers and see who's managing to swim against the current and who's getting totally swept away.
And what we're seeing is a really fascinating split. On one side, you've got some real bright spots. The IT and metal sectors, they showed some incredible resilience. But on the flip side, the heavyweight banking sector, well, that's become the big worry, and it's acting like a giant anchor on the whole market.
I mean, just look at who managed to come out on top right in the middle of all this chaos. Tech Mahindra jumped nearly 3.5%, and JSW Steel was right behind it, up over 3%. So what's going on here? Well, for tech, it was all about strong guidance from the global giant Accenture. And for steel, it's that simple, powerful story of resilient infrastructure demand. It's a great reminder that even in a down market, things like global cues and strong fundamentals can still create winners.
But then, you have the other side of the coin. HDFC Bank, a true titan of the Indian market, it stumbled badly, falling over 2%. And look, this wasn't just random market noise. No, this was triggered by a very specific, and honestly, a very surprising event, the sudden resignation of its non-executive chairman.
And the reason that was given was just this, a matter of values and ethics. That direct quote, it adds a really serious layer of gravity to the whole situation. See, when leadership changes happen under a cloud like this, it just creates this deep uncertainty. And if there's one thing the market absolutely hates, it's uncertainty. This was a major blow to investor confidence in one of the most important stocks on the entire index. Okay, so let's zoom out from the individual stocks for a minute and look at the huge macro forces that are putting pressure on the entire system. Because this really isn't about one company's bad news, this is about big money making big moves on a global scale.
It's the question on every single investor's mind, right? And the answer, really, it boils down to two incredibly powerful headwinds that are just battering the market right now.
First, just look at this number. It's staggering. In one single session last week, foreign institutional investors, we call them FIIs, they pulled over 10,000 crore rupees out of Indian stocks. So why the sudden exit? Well, it's mostly tied to global trends. With interest rates going up in the US, safer investments over there are starting to look a whole lot more attractive, and that pulls money out of emerging markets like ours. That kind of outflow, it's like a tidal wave of selling pressure.
Now, to be fair, our domestic institutions, think your mutual funds, they did their absolute best to absorb all that selling. They stepped in with a lot of buying, but the sheer force of that foreign money heading for the exits was just overwhelming. So the crucial takeaway here is this. As long as that big foreign money is running for the door, it is going to be incredibly tough for the market to find any kind of solid ground.
And this connects perfectly to the second major pain point. The Indian rupee just hit an all-time low against the US dollar. Now, a weakening rupee is like a triple threat. It makes our imports more expensive, which can fuel inflation, and it also makes our Indian assets look way less attractive to those same foreign investors. It's a classic and pretty nasty, vicious cycle.
So, after a really bruising week, what's coming next? Well, you might want to buckle up. We are heading into a shortened 4-day trading week that is absolutely jam-packed with events that are pretty much guaranteed to stir up a ton of volatility. So the first thing you need to know is the market is closed this Thursday for Ram Navami. That squishes all the action into just 4 days. What that usually means is that traders might rush to close out their positions by Wednesday, which could lead to a big spike in volume and some really sharp price swings. A lot of this is driven by something called short covering. That's basically when traders who bet on a stock falling have to suddenly buy it back, which can push the price up when you least expect it.
But here's something that's kind of wild. Despite all the gloom and doom in the main market, the primary market, that's where new companies list for the first time, it's still buzzing. We've got 4 new IPOs opening up, looking to raise over 2,000 crore rupees. It's a pretty clear signal that there's still a really strong appetite out there for new growth stories.
We've also got some major corporate events on the calendar to keep an eye on. Vedanta is meeting to talk about a dividend payout, HUDCO is looking at both a dividend and fundraising, and Natco Pharma is talking about a potential demerger of its businesses. Any one of these could cause some pretty significant moves in their stocks.
All right, let's shift gears and decode some of that technical jargon you always hear traders talking about. These indicators can actually give us some pretty powerful clues about the market's underlying health and what investors are thinking.
First up, the India VIX. The easiest way to think of this is just as the market's fear index. It doesn't tell you which way the market is going to go, but it measures how much of a price swing, how much volatility traders are expecting over the next month. So, a rising VIX means rising fear. Simple as that.
Right now, the VIX is kind of hovering around 1370, but it has been creeping up. The magic number to watch here is 15. If we see a sustained move above that level, it's a huge sign that the market is entering what traders call a panic zone, where sharp, unpredictable moves can suddenly become the new normal.
Next is the put-call ratio, or PCR. Now this one is a pure sentiment gauge. It's all about the market's mood. In really simple terms, a very low ratio, like the 0.63 we have right now, suggests that a huge number of traders are betting on a fall. And this can actually be what we call a contrarian signal. It means that when pretty much everyone is pessimistic, the market might just be oversold and due for a sharp bounce back, simply because there's nobody left to sell.
And this slide right here, this basically lays out the battlefield for the week ahead. For the Nifty 50, that 22,930 to 23,000 zone is the absolute critical defensive line for the bulls. If they lose that, look out below. And for the bears, the wall they need to break is between 23,350 and 23,500. These are the key lines in the sand you've got to watch.
Okay, so we have covered a ton of ground, right? From individual stocks to global economics and all the way to technical charts. So let's try to distill all of that into a final, sharp watch list for what is going to be a very high-stakes week.
Here are the 3 crucial triggers to keep on your radar. First, keep an eye on global Brent crude oil prices. If they stay above $105 a barrel, that's just going to keep fueling inflation fears and market jitters. Second, listen really closely to what the RBI says. The central bank is widely expected to stay hawkish. That means they're ready to raise rates to make sure things stay stable. And finally, this is an interesting one for the chart watchers. Certain historical patterns suggest we could be due for a potential trend change early in the week. It's not a guarantee, of course, but it's definitely something to watch for.
And that leaves us with the ultimate question, doesn't it? You've got an oversold market where the bulls are desperate for some kind of relief, but they're fighting against these powerful bearish forces and negative global trends. The stage is absolutely set for a major showdown. So will the market bounce from these critical levels, or is it going to break? Well, that's what we're all about to find out.